Martin Gahbauer, senior economist for Nationwide Building Society. Martin, good morning. Thanks for joining us.
Good morning.
So the monthly trend and the three-month trend seems to be deteriorating. Is it looking bleak right now? Things for the outlook for the housing market?
Well, certainly it's a picture of weakness at the moment. Ever since the spring months, we've seen a persistent weakening in buyer demand and at the same time a greater number of sellers coming to the market, and that is now being felt in house prices, which are on a modest downward trend. Prices are certainly falling, although not at the rate that they were in 2008, when the three-month rate of decline was in the 5 to 6% range. Currently, it's 1.5%.
I mean, the three-month figure's 1.5%. That could turn negative, couldn't it, by the end of the year? I mean, that's fairly significant.
The annual figure, you mean, yes, is
1.5%,
1.4% at the moment. If the current trend in prices were to persist in the final 2 months of the year, then yes, house price inflation would end the year in negative territory.
Is the only hope, Martin, right now more QE from the Bank of England?
Well, I think that that's something that could potentially stimulate the housing market a bit. It would have the effect of lowering fixed-rate mortgage rates, also potentially easing funding conditions for banks and raising household inflation expectations, which could encourage greater investment into property. However, I don't think that quantitative easing will have as big an impact on the housing market and house prices as the large cut in interest rates did. And as we know, interest rates cannot be cut any further than they already have been.
Well, I suppose in theory they could be cut to 0.25%, but probably not, as you say, Martin. With regards to QE, we had that strong third quarter growth figure, so that in itself might actually put back any date for implementing more QE, which in turn could affect the housing market?
It could. To the extent that quantitative easing is not implemented, you wouldn't have that additional monetary stimulus for the housing market, in which case, the downward trend of the last few months is probably a bit more likely to persist. However, I think what we really need to watch is whether the sellers who have returned to the market over the summer months subsequently withdraw from the market again when they see that the liquidity in the market and the prices being achieved are relatively weak. In that case, you might see prices stabilize sometime next year. That's a similar effect to what you had in early 2009, where after dramatic price declines, you had a big drop in the amount of property available for sale.
Martin, thanks. Martin Gahbauer there from Nationwide.